The first valuation method we'll learn is the comparable company analysis. It's often referred to as comps analysis or comps valuations as well. The principle behind comps valuation is extremely simple. So simple, in fact, that I think even maybe an elementary school student can understand it. It's one of the most widely used valuation methodologies in the industry, and it also frequently appears in newspapers and in news reports and so on. Even if you've never heard the term yet, you've likely come across the terms like PER or EV/EBITDA or price to sales. And for those who might still be unfamiliar with the concept, let me first explain the most basic principles in simple terms. So for example, let's look at the table on the right. Let's assume that we want to determine the market cap, so the equity value of our target company. And we currently have the information on the target company's net income, which is 10. And we want to find out about the market cap of the company. So the key idea of comps valuation is to find similar companies and compare them. So let's assume, for example, our target company is Marriott International. You all know the famous hotel franchise called Marriott. So if we have Marriott International, let's assume that we have three comparable companies such as Hyatt or Hilton or Intercontinental, those kind of hotel companies. Let's say we have three peer companies. And after organizing the data, we have the following. So peer A has a net income of 10 and a market cap of 100. Peer 2 has a net income of 20, but the market cap is the same. It's at 100 as well. Lastly, we have peer C. It's has a net income of 8, but a market cap of 120. So what this implies is that it's traded at a multiple of 10 times of the net income, 5 times of the net income. And lastly, for peer C, it's trading at 15 times of net income. So on average, what's happening is that they have market capitalizations averaging around 10 times their net income. This is the industry average. Therefore, we can estimate that Marriott International's market cap should also be 100. That is the net income multiplied by the industry average of 10 times. So the principle itself is very simple, isn't it? However, there are two methods within comps valuation. The first one we want to introduce is the trading comps analysis, and the second is transaction comps analysis. These two are very, very similar. So first, trading comps analysis, it involves comparing the target company to similar companies as we saw in the earlier example. It examines how the current market cap is valued relative to metrics like net income, operating profit, revenue, EBITDA, things like those. Because of this, the numbers can fluctuate in real time as long as the market is open. And non-listed companies are typically excluded from the comparison. So it's very hard to get market cap numbers for non-listed companies. But on the other hand, we have transaction comps, which looks at recent acquisition cases, so M&A cases of similar companies. So it analyzes the acquisition price relative to the net income at the time of the acquisition. So for example, if a company similar to Marriott International was recently acquired, you would examine how much net income it generated and what the acquisition price at that time was. The method involves gathering such cases and calculating an average of the multiples. So as a result, transaction comps analysis does not involve numbers that change in real time as it does in trading comps analysis. And we can say that as long as we have the data, we can also include non-listed companies when we're doing the comparison for transaction comps. But anyways, as we'll explore more in detail later on, the two methods have their strengths and as weaknesses as well. And we'll also go through the use cases as well. So it's very difficult to say which is better. They are just simply two complementary approaches that we can use and which are very valuable when it comes to valuation. We can compare it to when we're buying a house or a real estate property, and well, you might ask a real estate agent about the current market prices or similar properties in the area with similar age, the building age and the similar size. But alternatively, you can also ask about the recent closed transactions for comparable properties. So for significant investments, well, we would most likely examine both approaches thoroughly. So, and since these two principles are very similar, in our class, we will proceed using trading comps as the main example. And if there are differences, so if there are, anything worth noting that's different about transaction comps, we will explicitly point that out. So please keep that in mind. So we're going to go over a simple exercise of the two methods. So I believe most of you will be already familiar with Tiffany & Co. So it's a jewelry brand known for bracelets, or they sell necklaces. And let's say that currently Tiffany's stock price, we have the current company profiles of Tiffany. So share price is at 90. There's 120 million shares. Additionally, we have data like EBITDA, EPS, we have cash, we have total debt. We have already the data provided on the left-hand side. On the right, we have competitors like Hermes, Prada, Burberry, Louis Vuitton. These kind of companies, we already have gathered the EV/EBITDA multiples and the price to earnings multiples as well, which is at 15.5 times and 30 times X. So if you're unfamiliar with these concepts, you don't have to worry about this exercise. We'll cover them in detail later. But if you have a basic understanding, please pause for a moment and let's try to calculate the fair stock price. So the equity value per share on this data. So before starting, let's just clarify one thing. We are trying to calculate equity value. It's not the enterprise value we're trying to calculate, it's the equity value. We're only interested in the value of the stock eventually, which includes both the operating and non-operating value, and which is also from the common shareholders' perspective. Specifically, it's the value of one share, so one single share. So please pause this video for a moment and let's get back in a few minutes. All right, so let's get back to the problem. Where should we start? So because the EV/EBITDA multiple is on average 15.5 times X, what do we want to multiply on this multiple? We want to multiply the EBITDA for the EV/EBITDA multiple, and we want to multiply the EPS for the PE ratio. By doing this, we're left with Tiffany's enterprise value because EBITDA will be canceled out in the calculation. So Tiffany's fair enterprise value comes out to $15.5 billion. And next, for the equity value, how we calculate this is that we're going to use the enterprise value bridge formula. So EV, enterprise value, equals equity value plus debt value minus cash. So if we rearrange it to solve for the equity value, and since we already have enterprise value, we have total debt, we have cash. If we move it around, equity value comes out to $15.4 billion. And lastly, because we have 120 million shares outstanding, by dividing the 15.4 billion to 120 million, we're going to get a share price of 128.3 per share. And we can see that the current share price is at $90. So what does that mean? Well, it means that we should definitely buy the stock. So the fair value is 128, current share price is 90. We're saying that it's definitely undervalued. Now let's take a look at the PE multiple as well. So for the PE multiple on the right, it's given an average of 30 times X and EPS is $4.5. Multiplying these two gives us a fair stock price of 135. We're going straight to equity value per share because EPS is already on a per share basis. And again, since the current stock price is $90 and we have equity value per share at 135, again, the recommendations would be a buy recommendation. So in this case, there's no need to go through the more complex calculation of going to enterprise value and using the bridge and dividing by shares. It's just much more simple for the PE ratio case. So that's how we, perform trading comps valuation. It's quite simple and quite easy to understand. The next example, we have transaction comps. So unlike trading comps valuations, this method doesn't evaluate companies based on their current trading prices. Instead, as you can see, we have past M&A transaction data. So for instance, back in 2011, when Louis Vuitton, they acquired Bulgari, well, the deal was made at 25.8 times X, the Bulgari's EBITDA at that time. And similarly, we can see that, when Coach, acquired Kate Spade, it's quite more recent in 2017. Well, it was quite low. So EV/EBITDA multiple was at 10.4 times X. And we can see that on an average, well, we only have 4 examples at this moment, but in actual practice, probably there will be more cases. But anyways, in average, we have a multiple of 18.5 times X, the EV/EBITDA multiple, and the rest is pretty much the same. We want to, multiply Tiffany's current EBITDA. We're going to get enterprise value. We're going to use the bridge formula to calculate equity value. So we are subtracting debt and then adding back cash to get to equity value. And then we're dividing it by the number of shares, total number of outstanding shares, and we're going to get a result of $153 per share in equity value. Again, we can say that the stock is undervalued as the current share price is at $90. Well, as you can see, this method is pretty much similar to what we did in trading comps valuation, only this part here is slightly different. Lastly, for your reference, this example is actually based on the fairness opinion document prepared during the Tiffany & Co.'s M&A. Such a document, it assesses the fairness of an M&A deal we've briefly explored the principles of these two methods, but don't worry if you didn't fully understand them, just in case. From now on, we'll take a more detailed and a step-by-step approach to study these valuation techniques.